Climate change is a massive problem, or is at least perceived to be one. According to the IPCC, we'll need to invest $125 trillion into every possible vertical we can to help solve this crisis, funding a transition to a net zero world. Carbon capture will be an integral part of that process. In this video, we're going to review the two primary pure-play carbon capture investment options available to retail investors right now: Aker Carbon Capture, ticker ACC, and LanzaTech, ticker LNZA. But first, let's talk about how carbon capture works and the current market dynamics of the industry. Carbon capture involves capturing CO2 directly at the source of emission: power plants, industrial production facilities, you name it. This is done in hopes we can capture those emissions before it gets out into the atmosphere. There are three primary carbon capture technology methods used right now: pre-combustion, post-combustion, and oxy-fuel combustion. Pre-combustion takes coal, or whatever fuel is going to be used in the production of electricity, converts it into a gas mixture, and takes out the CO2 before it's burned. Post-combustion separates CO2 from the waste gas that would come out of a plant smokestack by using a chemical solvent. This is done after the fuel is burned and is the most common type of carbon capture. Lastly, there's oxy-fuel combustion, which burns fuel in a nearly pure oxygen-based environment to reduce the presence of other gases, and then the CO2 can be captured more easily. So with those methods in mind, the question is, after we capture the CO2, what does the company do with it? The CO2 can be used in other processes like enhanced oil recovery, stored underground, or used in the production of other products. There are a variety of different industrial applications that CO2 can be used in, like carbonating beverages, producing fertilizers, propellants, and so on. Now, what kind of growth can we expect in this industry? Bloomberg NEF estimates that carbon capture capacity will increase by 6 times by 2030. There are a variety of estimates that the market will grow to a valuation of $10 to $20 billion in that same timeframe. So growing demand for carbon capture is only becoming more evident as time goes on. Just taking the number of steel, cement, and power plants globally, that is around 35,000 different emission sites. These industries produce a significant level of greenhouse gas emissions. Now that 35,000 is the global total, so many of them are not under any type of carbon tax at the moment, and they also vary by size, but you can see how large this market could get over time. There is no shortage of potential demand. Canada is increasing carbon taxes, the USA has the Inflation Reduction Act, India and China are introducing emissions trading systems on their power generation industries. Europe already has the largest emissions trading system in the world. The Middle East is exploring carbon capture as a way to maintain their oil and gas sector, so there are a lot of tailwinds moving in carbon capture's favor right now, especially as the world increases the usage of carbon taxes and increases the number of tax credits or other subsidies provided for carbon capture solutions, which are the main financial incentives behind the usage of carbon capture in the first place. The thesis is that the cost of carbon through taxes or emissions trading systems will be higher than it costs to pay for carbon capture facilities, so the build-out of these carbon capture plants actually becomes a cost-saving initiative for industrial companies. Carbon capture typically costs around $50 to $150 per ton of CO2 captured, depending on the process and cost of energy in the area. This is cheaper than direct air capture, which doesn't take flue gas from smokestacks, but actually takes CO2 directly out of the air. DAC can cost as much as several $100s per ton or more, so carbon capture is still pretty expensive either way. This has led to carbon capture mainly being utilized in Europe as of right now, although we are seeing more and more expansion globally. The price of emissions allowances in the EU has been dropping recently, but prices are expected to be around or over €100 per ton of CO2 in the coming years. Given this is the price that heavy emitters need to pay to cover their climate obligations, this provides financial incentive for the usage of a solution like carbon capture. Now we know there will be plenty of demand, and it's only growing, but what does the supply side look like? Thanks to an article from Energy Digital, we can at least get a good idea of the pure-play companies and where they stand as of February 2023. So the article was a bit outdated, but this at least gives us an idea of where these companies are at. As you can see, the two stocks I mentioned before, Aker and LanzaTech, are numbers 3 and 5 respectively by carbon capture capacity. These rankings have probably changed a bit since last year. Both companies have increased their capacity as well, but that's a reference for the pure plays. As far as the largest carbon capture facilities in the world, which is significantly more than the capacity of these smaller pure play companies, all of them are owned by the large oil and gas operators. ExxonMobil, Chevron, Shell, many of the world's heaviest emitters have developed their own technologies. so there's plenty of competition, even if there aren't many publicly traded options to invest in. With that said, let's look at our options and see if any could be worth investing in, starting out with Aker. Aker Carbon Capture, ticker ACC, has a market cap of $450 million in the US. They've been developing their carbon capture technology for over 20 years now, but they only recently became a standalone company in 2020. We'll talk more about that later on. Their technology works by taking untreated flue gas, or waste gas from the smokestacks of heavy-emitting industry. The CO2 within that gas binds to an amine solution, which is heated to release the CO2 and is subsequently liquefied and stored. The system comes in a variety of sizes and models. Their Just Catch units can be 40,000, 100,000, or 400,000 tons of carbon capture capacity per annum, and those units are modular, so costs will decrease as economies of scale are achieved. These plants are exclusively built by Aker, and they also offer carbon capture as a service, where an emitter can pay Aker per ton of carbon captured. Just Catch Offshore can come in similar sizes and will be used on floating, production, storage, and offloading, also known as FPSO vessels. They process crude oil or gas from underwater oil wells, and this offshore unit would be placed on board and limit its emissions. Those will be built by Aker, but Aker also licenses out the technology for other companies to build themselves. The same can be said for Aker's largest offering, the Big Catch, which is a more bespoke model, so they'll be tailored in size and characteristics for the emitter, and the technology will be licensed out to the emitter so they can build a large facility themselves. So Aker's business model is primarily focused on building the facilities and then providing aftermarket maintenance or supplying the amine solvent necessary for the carbon capture process. Licensing and generating royalties from that will be an option, but most revenues will come from more capital-intensive construction on Aker's side. As far as the cost of their solution, depending on location, specifics, and the cost of electricity in the area, the cost of capturing a ton of CO2 can range from $55 to $120 in North America, and €75 to €175 in Europe, meaning that Aker is closing in on the point where their technology can be profitable for emitters, especially, as we mentioned earlier, when the cost of CO2 is projected to be over $100 per ton in the EU over the coming years. Aker primarily operates in the EU currently. This is where the financial incentives have made it viable for the longest time, but now the company is gauging interest in North America and the Middle East as well. They have several existing partnerships to help Aker expand in these regions. They have an MOU with Man Energy Solutions to expand in North America, and Aker also has an MOU out with Saudi Aramco, which is the state-owned oil company in Saudi Arabia, to explore opportunities to deploy carbon capture technology, so interest is certainly on the rise. Their backlog of projects is quite expansive, with a total of 84 units under studies or testing agreements. Another 7 are actually under supply agreements and contracted. This translates to an order book worth around $260 million in total in USD. One of those 7 is at Twence's waste-to-energy plant in the Netherlands. This is Aker's first commercial unit, at 100,000 tons of carbon capture capacity per year. They're in the process of commissioning the unit, and it's already mechanically built and delivered. The second project, which will be delivered in 2024, will go to the Brevik CCS project in Norway for Heidelberg Materials, 400,000 tons of capture capacity. And the list goes on, with a variety of projects in various stages, including potential projects with companies like BP and Uniper as well. Now, to speak on the management team, the company is run by executives that primarily came over from other companies within the Aker group. With that said, the executive team is pretty new, and they don't own a significant stake in the company themselves, essentially no stock at all. Aker Carbon Capture is a subsidiary of Aker Horizons. Horizons owns about 43% of Aker Carbon Capture, and Aker Horizons is also a subsidiary of Aker ASA, which owns a portfolio of companies in industries like oil, fishing, renewable energy, construction, and more. Aker ASA is one of the top 20 largest companies in Norway, founded by a man whose name I will not try to pronounce since it's quite Norwegian, but he is the richest man in the country, currently worth around $4.5 billion USD. Safe to say being connected to the richest man in the country benefits Aker Carbon Capture, and the company collaborates with Aker Horizons and Aker Solutions on potential financing, construction, and engineering. So there are a variety of potential synergies where companies under the Aker umbrella help each other or provide services. As far as Aker's financial position, they're generating revenues from engineering services primarily, and construction of the carbon capture plants. Revenues are growing quite rapidly, 139% growth from last year as of Q4 2023, and these numbers are in Norwegian krones. I'm going to convert them all into USD for you. So they're generating revenues of around 54 million, and losing around 4 million in EBITDA. They're not making progress on profitability as far as I can tell, and they're unable to give a timeline on when they'll get there. They also refused to provide estimates for basically anything on the financial front in their last conference call. In total, they're losing around $20 million per quarter, with around $105 million in cash. They theoretically have about a year before they'd have to raise money if they don't get to profitability. My assumption is that they will have to raise money or find some creative financing options. The company is not exactly cheap either, currently trading at a price-to-sales ratio of 4, with gross margins in the 5 to 10% range that are pretty bad as well. So this is certainly a capital-intensive business. There's also significant competition from a variety of companies that will provide similar solutions. There's a total lack of confidence in reaching profitability anytime soon. All these factors lead me to say that Aker is a hard pass. Even if there are large macro tailwinds in their favor, there's nothing stopping the stock from continuing to fall as it has since 2021. I think there are better investment options out there, even if the stock were to get pretty cheap, quite frankly. With that said, the second investment option we have is a little more interesting to me. That company's LanzaTech, ticker LNZA. They have a market cap of around $675 million. This company went public through a SPAC, so it's not hard to imagine how the stock performance has been since they went public last year. Not good. But let's dig a little deeper here. So what does the technology look like? Well, instead of an amine solution like Aker, Lanza's developed a reactor system that works similarly to the fermentation process of beer. Lanza can gasify municipal waste or take in waste gas from industrial processes. That gas is compressed, cleaned, and then fermented using microbes, aka anaerobic bacteria. The bacteria is fed carbon dioxide or other waste gases to create ethanol. That ethanol can be used to create different materials or sustainable aviation fuel. And they're creating those fuels under a spin-out company called LanzaJet, which LanzaTech retains a 25% ownership of. But the interesting part is that the bacteria can not only create ethanol, but Lanza's genetically modifying strains of bacteria to create different chemicals as well. Other chemicals they've proven in lab testing have been chemicals like isopropanol or acetone, just to name a few examples. So Lanza can tailor the end product to whatever the emitter wants to create, just by using different strains of bacteria in the process. Again, Lanza's been developing this technology for over a decade now, so it does take time to bring these processes to fruition. That's a benefit for these companies at the very least. As of last year, Lanza had 1,250 patents and another 575 pending. They've been pioneers in the gas fermentation field when it comes to carbon capture, and it seems like their technology is more unique than a lot of the other carbon capture solutions out there, as far as I've seen. With that said, Lanza has 6 different plants up and running. All of them produce ethanol currently, so they're further along than Aker. Most of these plants follow a similar design for efficiencies of scale. 4 of them are in China, 1 is in India, and the latest plant is in Belgium. Lanza also has a strong pipeline of potential projects for future construction, with a combined 30 projects in advanced and early stage engineering, and another 60 or more in active engagements. So there's no question that there's strong demand for Lanza's solution. For partnerships, Lanza has a variety of interesting names involved. Brookfield's committed to investing a maximum of $1 billion in Lanza projects, so that can be a new source of demand on its own. Lanza is exploring sustainable aviation fuel production with Tadweer, which is the only waste management company in Abu Dhabi, and same for ADNOC, which is Abu Dhabi's national oil company. Also in the Middle East, Lanza is working with Olayan Financing Company to deploy technology in Saudi Arabia. Moving over to India, they're working with GAIL, India's largest natural gas company, to set up a pilot-scale facility to test with GAIL's waste streams. So that's another expansion avenue. And lastly, Sinopec, the Chinese oil and gas company, one of the largest in the world, owns a nearly 9% stake in Lanza, and they've already built 4 plants with them as well. So this is a massive partnership to have, and all these potential projects are highly accretive to Lanza. One of the key differences from Aker is Lanza's business model. Lanza is primarily focused on licensing out its technology to these large emitters. They generate revenues for engineering services, but they'll have recurring royalties for providing the technology, the bacteria used in the process, and software as well. One of their other revenue streams is from joint research on new products with potential market participants, researching new strains of bacteria or types of carbon capture. Lastly, Lanza has the Carbon Smart platform, which is the usage of ethanol or other offtake products to create sustainable materials or chemicals. This includes clothing, polymers, or aspects like their collaboration with Dow to create biodegradable cleaning solutions. Overall, these revenue streams will lead to higher margins than a company like Aker, especially when Lanza is not building out their own facilities. The emitters take on the capex, but they also get the byproducts like ethanol in return. LanzaTech's technology is profitable for the emitter already, without even including extra financial incentives from government legislation, generating $1 billion in revenue over the life of the project, which is approximately 20 years. In terms of what this means financially for Lanza, they generate around $8 million per year in revenue from royalties after they ramp up. 90% of the revenue created from these plants are recurring royalties. Looking at the company's latest financial results, which was in Q3 2023, as of the recording of this video, Lanza generated nearly $20 million in revenues, with gross margins of 27%. So we can see it's certainly higher than Aker, but still not that great. Royalties will become an increasingly large percentage of their revenues over time, so I would expect those margins to improve as time goes on. Keep in mind when these results came out, Lanza was still in the process of ramping up and building several new plants. Their net loss for Q3 was $25 million, leaving the company with nearly $137 million in cash at the end of the quarter. Lanza has projected they'll be break-even on EBITDA by the end of 2024. Obviously, if they keep burning this much cash, they'll need to dilute in a little over a year. And chances are they will need to dilute to actually reach profitability, but overall the company is starting to scale and the fundamentals should continue to improve. As you could imagine, LanzaTech's management team is full of scientists and engineers. Many of them have previous experience in the petrochemical industry as well, or they've been working with Lanza for so long that they moved up to executive positions. So the team seems solid from a cursory glance. For insider ownership, the management team owns approximately 6% of the company, which is typically less than I'd like to see, but at least they do have a financial interest in seeing the stock do something. Now the valuation is where things start to go awry. A price-to-sales ratio of 41 is an NVIDIA kind of multiple. Granted, the stocks have vastly different characteristics, but you get my point. This company was a SPAC and needs to level out at a more reasonable valuation. It's not cheap by any means. And the majority of the revenues are coming from engineering services, obviously labor-intensive and low margin, then this type of valuation is simply not justified. So Lanza is better than Aker, no doubt. Licensing will lead to better margins over time. Their technology is also differentiated compared to other options because of their ability to produce different end products with their bacteria. With that said, many of the same problems still remain because of the industry they're in. There's significant competition in the carbon capture space. I think LanzaTech has the possibility to differentiate itself more than Aker, but the question is, how cost competitive will these companies be in comparison to other players in the industry? That's really what's going to determine whether these stocks succeed or not. It's hard to know how everything will shake out, but it's comforting to see both companies with strong pipelines for growth. I think LanzaTech is the better company of the two, but either way, these companies are overvalued for where they're at in the commercialization of their technology, especially with the gross margins they currently have. Both companies will need to dilute within the next year or two, so it's probably best to wait for valuations to come down. If you'd like to hear more about other possible green investments and ways to benefit from the trend towards the energy transition, consider subscribing to my channel, Green Investing. You can also follow me on my other social media, like X or Substack, links in the description. Thanks for watching.